Small cap and large cap stocks represent two fundamentally different categories of publicly traded companies, classified primarily by their market capitalization, the total dollar market value of a company's outstanding shares. Market cap is calculated by multiplying the current stock price by the total number of shares available in the market. Generally, large cap companies are those with a market value exceeding $10 billion, often including household names like Apple, Microsoft, or Johnson & Johnson. These corporations are typically mature, with established business models, global operations, and consistent revenue streams. On the other hand, small-cap companies usually fall within the $300 million to $2 billion range, representing younger, regional, or niche-focused businesses that are still in growth or expansion phases. These firms may not yet be widely recognized by the general public, but they often operate in emerging industries or underserved markets. The distinction between these categories is not arbitrary. It directly affects liquidity, volatility, investor accessibility, and long-term return potential. While large caps are often considered the backbone of conservative portfolios, small caps are viewed as engines of aggressive growth. It's critical to understand that cap size is not just about company size. It reflects business lifecycle stage, operational scale, risk profile, and investor expectations. Many new investors mistakenly believe that all stocks behave similarly, but the reality is that small and large caps operate under entirely different market dynamics. Recognizing these foundational differences is the first step toward building a balanced, intentional, and strategically diversified investment portfolio. Without this baseline understanding, investors risk misallocating capital based on emotion, hype, or incomplete information, which can lead to unnecessary losses or missed opportunities. One of the most defining characteristics separating small cap from large cap stocks is their respective levels of risk and price volatility. Small cap stocks tend to experience significantly wider price swings over shorter periods due to lower trading volumes, thinner analyst coverage, and less institutional ownership. Because fewer investors are buying and selling these shares at any given time, even modest trades can cause disproportionate price movements, a phenomenon known as low liquidity risk. Additionally, small companies are more vulnerable to economic downturns, supply chain disruptions, regulatory changes, or loss of key clients, since they often lack the financial buffers, diversified revenue streams, or operational redundancies that large corporations maintain. A single negative earnings report or management misstep can send a small cap stock plummeting, whereas a large cap might absorb the same news with only minor fluctuations. This doesn't mean small caps are bad investments. It simply means they carry higher inherent risk, which must be consciously managed. Large cap stocks, by contrast, benefit from economies of scale, brand recognition, and access to global capital markets, allowing them to weather storms more effectively. Their share prices are influenced by macroeconomic trends rather than micro-level events, making them more predictable and less prone to erratic behavior. For risk-averse investors or those nearing retirement, large caps offer stability and capital preservation. For those with longer time horizons and higher risk tolerance, small caps can offer explosive upside, but only if the investor understands and accepts the accompanying turbulence. Ignoring this volatility differential is one of the most common and costly mistakes retail investors make. Risk isn't just a theoretical concept. It manifests daily in bid-ask spreads, trading halts, margin calls, and emotional decision-making. Understanding volatility isn't optional. It's essential for survival in the equity markets. When evaluating return potential, small-cap stocks historically offer greater long-term growth compared to their large-cap counterparts. But this potential comes with important caveats. Small companies are often in earlier stages of their business lifecycle, meaning they have more room to expand, innovate, capture market share, or disrupt established industries. A $500 million company growing revenues by 30% annually has a much clearer path to becoming a $5 billion company than a $500 billion company trying to sustain double-digit growth. This scalability is what attracts growth-oriented investors and venture-style portfolios to the small-cap space. Many of today's large-cap giants, Amazon, Netflix, Tesla, were once small-cap stocks that delivered astronomical returns to early believers. However, it's crucial to recognize that not all small caps will succeed. In fact, a significant percentage will stagnate, get acquired, or go bankrupt. The key is identifying which ones have sustainable competitive advantages, strong management, and addressable markets large enough to support exponential growth. Large cap stocks, while more stable, typically offer slower, more predictable growth, often in the single digits annually. Their size makes hypergrowth mathematically difficult, and their strategies are usually focused on efficiency, shareholder returns, and incremental innovation rather than radical disruption. That said, large caps still compound wealth over time, especially when dividends are reinvested. The real opportunity for investors lies in balancing both, using large caps for foundational stability and small caps for asymmetric upside. Historical data from indices like the Russell 2000 small cap versus the S&P 500 large cap shows that over multi-decade periods small caps have outperformed, but with much higher drawdowns and emotional stress along the way. Growth potential must always be weighed against survivability. The goal isn't to chase the highest possible return. It's to find the optimal risk-adjusted return for your personal financial objectives and psychological tolerance. Liquidity, the ease with which an asset can be converted into cash without affecting its market price, is one of the most underappreciated factors when comparing small cap and large cap stocks. Large cap stocks benefit from massive daily trading volumes, tight bid-ask spreads, and deep institutional participation. This means investors can enter or exit positions quickly, even with large order sizes, without significantly moving the price. For example, selling 10,000 shares of Microsoft is unlikely to impact its market value because millions of shares trade hands every minute. Small cap stocks, however, often suffer from low liquidity. Daily volume may be measured in thousands rather than millions of shares, and bid-ask spreads can be wide, sometimes 1% or more of the share price. This creates a hidden cost for investors, the slippage between the price you expect and the price you actually get. In extreme cases, attempting to sell a large position in a thinly traded small cap can trigger a price collapse, forcing you to accept a much lower value than anticipated. Liquidity also affects accessibility. Many small caps aren't covered by major brokerages, may not be available in retirement accounts, or could be excluded from certain index funds and ETFs. Additionally, during market stress or flash crashes, liquidity in small caps can evaporate entirely, leaving investors unable to exit even if they want to. Large caps, by contrast, remain liquid even in turbulent markets, acting as safe harbors during panic sell-offs. This doesn't mean small caps should be avoided, but investors must plan their entry and exit strategies carefully, use limit orders instead of market orders, and never allocate more than they can afford to have temporarily locked up. Liquidity risk is silent until it strikes, and when it does, it can turn a winning investment into a trapped asset. Always consider not just what you're buying, but how easily you'll be able to sell it when the time comes. The level of analyst coverage and public information available varies dramatically between small cap and large cap stocks, and this asymmetry directly impacts investment decision-making. Large cap companies are typically followed by dozens of Wall Street analysts, covered extensively in financial media, and subject to rigorous scrutiny from institutional investors, regulators, and academic researchers. Earnings calls are widely broadcast, SEC filings are dissected in real time, and any material development is instantly reflected in the stock price. This creates a highly efficient market where information is rapidly priced in, leaving little room for informational arbitrage. Small cap companies, however, often fly under the radar. Many have zero or only one or two analysts covering them, and press coverage is sparse or non-existent. Financial statements may be harder to interpret, management teams less accessible, and corporate governance practices less mature. This lack of transparency creates both risk and opportunity. On one hand, investors may struggle to verify claims, assess management credibility, or understand competitive positioning. On the other hand, this information gap can lead to market inefficiencies, meaning astute, patient investors can uncover undervalued opportunities before the broader market catches on. Due diligence becomes exponentially more important in the small cap space. Investors must read annual reports, study industry trends, monitor insider transactions, and sometimes even contact company IR departments directly. Large cap investing can be more passive. You're often betting on macro trends or index performance. Small cap investing is inherently active. It demands research, skepticism, and independent judgment. Relying on headlines or social media hype in the small cap world is a recipe for disaster. The winners are those who dig deeper, ask harder questions, and verify assumptions with primary sources. In large caps, you're surfing the wave. In small caps, you're building the surfboard, and you'd better know how to do it well. Small cap and large cap stocks are not randomly distributed across the economy. They tend to cluster in specific sectors and industries, reflecting their different stages of maturity, capital needs, and market opportunities. Large cap dominance is most visible in sectors like technology, Apple, Microsoft, healthcare, Johnson & Johnson, Pfizer, financials, JP Morgan, Bank of America, and consumer staples Procter & Gamble, Coca-Cola. These are industries characterized by high barriers to entry, global scale, brand loyalty, and regulatory complexity, all of which favor established players with deep resources. Small caps, conversely, are more prevalent in emerging or fragmented industries, biotech startups developing novel therapies, niche software tools for underserved verticals, regional banks, specialty retailers, or clean energy innovators. These sectors often lack dominant players, creating room for disruption and rapid growth, but also higher failure rates. Importantly, small caps provide exposure to parts of the economy that large caps simply cannot access. For example, while large cap industrials focus on aerospace or global logistics, small caps might specialize in drone delivery systems or modular construction tech. This sector divergence means that a portfolio composed solely of large caps may miss out on thematic growth trends, like AI infrastructure, decentralized finance, or lab-grown meat, until they've already been absorbed by conglomerates. Conversely, a portfolio overweight in small caps may lack exposure to defensive, cash-generating industries that perform well during recessions. Smart investors use this sector imbalance to their advantage, overweighting small caps in high-growth, high-conviction themes while using large caps for core stability and dividend income. Sector rotation strategies also behave differently across cap sizes. Small caps may lead early-cycle recoveries, while large caps often outperform late-cycle or during downturns. Understanding where each cap size thrives, and why, allows investors to align their allocations with economic cycles, technological shifts, and demographic trends. It's not just about company size, it's about positioning within the evolving economic landscape. Constructing a portfolio that intelligently blends small cap and large cap stocks requires more than just picking favorites. It demands a strategic framework based on goals, time horizon, risk capacity, and market conditions. A common mistake is treating both categories as interchangeable or assuming one is universally better than the other. In reality, they serve fundamentally different roles. Large caps act as the foundation, providing stability, income via dividends, and low volatility compounding. They are the ballast that keeps your portfolio from capsizing during storms. Small caps, meanwhile, serve as the accelerant, offering higher growth potential, diversification benefits, and exposure to innovation, but with increased turbulence. The ideal allocation depends on your personal profile. A 25-year-old investor saving for retirement may allocate 20 to 30% to small caps, comfortable with the volatility in exchange for long-term upside. A 60-year-old nearing retirement may limit small caps to 5 to 10%, prioritizing capital preservation. Even within small caps, diversification matters, spreading exposure across sectors, geographies, and market caps, e.g., including mid-caps as a bridge, reduces idiosyncratic risk. Rebalancing is also critical. During bull markets, small caps often outperform, causing them to become overweight in your portfolio, increasing risk unintentionally. Periodic rebalancing back to target allocations enforces discipline and locks in gains. Conversely, during bear markets, small caps may crash harder, creating buying opportunities for those with cash reserves and strong stomachs. Tactical adjustments can also be made based on economic cycles, increasing small cap exposure during early recoveries, shifting toward large caps as markets peak. Importantly, avoid emotional allocation. Chasing performance after a small cap rally or panic selling during a drawdown destroys long-term returns. Use rules, not moods. Finally, consider using ETFs or index funds for broad exposure, especially in small caps where individual stock picking is riskier. A blended approach, combining passive large cap indexing with active or thematic small cap selections, often delivers the best risk-adjusted outcomes. Portfolio construction isn't about maximizing return, it's about optimizing return per unit of risk you're willing to endure. Understanding the differences between small cap and large cap stocks is not an academic exercise. It's a practical necessity for anyone serious about building lasting wealth in the equity markets. Neither category is inherently superior. Each plays a distinct, valuable role depending on your goals, timeline, and temperament. Small caps offer the potential for life-changing returns, but demand research, patience, and resilience. Large caps provide consistency, income, and peace of mind, but rarely deliver explosive growth. The most successful investors don't choose one over the other, they integrate both intelligently, using large caps as the foundation and small caps as the growth engine. Always remember, volatility is not risk. Risk is the permanent loss of capital. Small caps increase volatility, but with proper due diligence and position sizing, they don't necessarily increase true risk. Likewise, large caps reduce volatility, but complacency or overconcentration can still lead to significant losses. Monitor your portfolio regularly, rebalance with discipline, and never let short-term noise override your long-term strategy. If you're new to small caps, start small, allocate 5%, learn the dynamics, and scale up only as your confidence and competence grow. Use screeners, read annual reports, follow insider activity, and avoid hype-driven tickers. In large caps, focus on quality, strong balance sheets, consistent earnings, shareholder-friendly policies. Avoid zombie large caps that are declining but propped up by index inclusion. Ultimately, the market rewards those who think independently, act patiently, and manage risk consciously. Whether you lean towards small caps, large caps, or a blend of both, make sure your choices align with your personal financial plan, not with headlines, influencers, or FOMO. Now it's your turn. If this breakdown helped you see the market with more clarity, do me a favor, hit that like button, subscribe for more no-nonsense investment analysis, and drop a comment below telling me which cap size you're currently overweight in and why. Share this video with a friend who's still confused about where to invest. Knowledge only multiplies when it's shared. Let's build smarter portfolios together.